Are you considering buying a new home but feeling kind of lost in the world of mortgages? Well, fear not, because today we're going to demystify that whole process and shed some light on how mortgages are actually calculated and why it's so critical for you to pay attention to interest rates and your credit score so you can get the best deal possible. Hello everybody, Dan McCarthy here, your YouTube realtor on Boston's North Shore. As a real estate agent and investor, I've had my fair share of experiences buying and selling and restoring properties. Today, I want to share some insight with our first-time buyers about mortgages, including what they are, how they work, mortgage rates, and credit scores. So let's dive right in. First off, what's a mortgage? Essentially, it's a loan you take from a bank to finance the purchase of a home. It's just like any other loan. The bank will charge you interest to borrow that money. The interest rate, or mortgage rate, is the cost of borrowing that money to purchase the home. The interest rate represents the percentage of the loan amount that must be paid back to the lender in addition to the actual principal of the loan. The interest rate is calculated yearly, which means per year. The lower the rate, the less it costs you to borrow the money. That's pretty simple, right? This means more money stays in your pocket, which is great. When interest rates are low, buyers can also qualify to borrow more money and potentially buy a nicer house. Conversely, when rates are high, you can't borrow as much money, which might result in settling for a smaller or less luxurious home in a less desirable neighborhood. Now let's take a look at an example of a 30-year fixed-rate loan where we borrow the same amount of money but the interest rates change slightly. Let's say you're buying a $500,000 house in Wakefield and you're putting 10% down as a cash deposit, so you'll need to finance the remaining $450,000 with a loan from Wakefield Bank. The best rate they offer now for a 30-year fixed-rate loan with a 10% down payment is 4%. The bank has plugged in all the numbers and determined that your monthly mortgage payment would be $2,148.37. to borrow $450,000 at 4% for 30 years. Since it's a fixed rate loan, the payment stays the same. This payment does not include town taxes, homeowners insurance, or any PMI required by the bank. It's just principal and interest on your loan. So you might be wondering, where did this monthly payment come from? Well, since the interest on $450,000 for 1 month is $1,500, why is my payment more? Well, you actually have to pay the interest on the loan, but you also need to pay back the actual principal of the loan. So banks use a special formula to calculate a single payment amount that covers both principal and interest for the months as time moves on. And here's the formula. Now, this formula amortizes the loan over 360 months and determines a payment amount that will pay the required interest each month, and the remaining portion of that payment goes toward paying down the actual balance or principal of the loan.
Are you joking?
Now, that's pretty tricky math, but if you plug in the numbers, it's accurate. Next, let's take a look at the amortization schedule for the first several months. Most of the mortgage payment goes towards satisfying the interest, not the principal balance of the loan. This is a standard way that lenders amortize a mortgage, so it's the same everywhere you go. One thing to note on the graph is that the interest and balance lines intersect around the 13th or 14th year. This is where the interest payment and the principal payment are the same amount. So you need to have paid almost 14 years worth of payments before half your monthly mortgage is used to pay down the principal. It might seem crazy, but it's just the way it works. Now, just for the heck of it, let's bump up the interest rate to 5%, just 1 point higher. Now, that 1 point actually raises your payment by $267 a month, which is pretty substantial considering it's only 1 point. You know, the first car I financed was $233 a month, so $267 a month is definitely something. Now, don't forget, this is a 30-year loan, so take a look at how 1 point impacts the overall percentage of the interest to the principal for each loan. The 4% loan shows 42% interest and 58% principal, while the 5% loan shows 48% interest and 52% principal. Even more, take a look at the total interest paid for each loan. Could you put your kids into private school with that money, or maybe buy a new car? You see what I'm getting at? Just for fun, let's take a look at the same loan at 6%. That shows a savings of $198,000 between the 4% loan and the 6% loan. So if your credit score isn't great, now is the time to start working on it. There are plenty of videos on YouTube that can give you tips on improving your score. Number 2, the Federal Reserve sets the federal interest rate, which influences mortgage rates. When the federal rate is low, mortgage rates tend to follow suit. Keeping an eye on the federal interest rate can help you determine when it might be a good time to buy or refinance. Number 3, there's a myriad of mortgage products available to suit everybody's needs, right? Fixed rate mortgages maintain a consistent interest rate over the life of the loan, providing very predictable monthly payments. And variable rate mortgages rate can change over time, typically following market trends. Also, FHA loans offer lower down payment requirements and flexible credit score guidelines, making them really popular among first-time home buyers. There's also 203K loans, which are designed for a home buyer looking to finance both the purchase of the property and any necessary repairs. Now, when selecting a mortgage product, consider that most people stay in their homes for an average of 7 to 10 years. If you plan to move within that time frame, a variable rate mortgage might make more sense. If you prefer stability and predictability, a fixed rate mortgage could be a better choice for you. To summarize, keeping track of your credit score, working with a mortgage professional, staying informed about the housing market, and choosing the right mortgage product can all help you get the best possible rate when applying for a mortgage. Remember, the more you know, the better equipped you'll be to make the best decisions for your financial future. I hope you found this information helpful and gained some valuable insights into mortgage rates. If you have any questions or need advice, feel free to leave a comment below or reach out directly to me. Don't forget, like, subscribe, and share this video with anyone you think might benefit from this information. I'm Dan McCarthy with eXp Realty on Boston's beautiful North Shore. I'll see you in the next video.